2019 DEB cash production budget. So it says cash budgeting, but really they're nearly closer to a production budget in many ways than a cash budget. So you'll be asked to do a very series of little small budgets. So the first one is to prepare a production budget. So if you can remember from doing production budgets, that's the number of units we have to produce to sell a certain amount. So that's our sales. We take away our opening stock from sales, and we're going to add our closing stock, and that'll give us the units to be produced. So it asks us to prepare a production budget for 4 months, July to October. Now you'll see I've it laid out July, August, September, October. I've actually gone all the way to November, and I'm even with it in that. I'm going to have to just put down December as well for a second, and we'll see why that is for a minute. Because these are all forward-looking, we have to be mindful of that. So, what does it tell us? Sales in units. So they are 10,500 for July, and we'll just fill in as they are across. 11,500 for August. September is 12,500. September is 12,000. October is 12,500. November is 13,000, and December is 13,500. I don't really need this December column. I'm just doing it for in effect to show you something in a little bit. So what's it tell us then? Well, they're preparing to set up a new business. So straight away they are a new business, so they have no opening stock in the first month. So we know that. But it doesn't tell us anything about stocks of finished goods, or does it? Well, it does. So it tells you stocks of finished goods are maintained at 70% of the following month's sales requirements. So in units, we want to keep 70% of what we're selling next month. So if we're selling 11,500 in August, in July, we want to keep 70% of that. So it's going to be 70% of 11,500, which is 8,050. Okay, and we just keep working across. In August, we want to keep 70% of September. In September, we want to keep 70% of October, and so on. 70% of November. And this is why we need December here. So it's 70% of December. And that's, by the way, December dealt with now. We don't need that anymore. There's a reason we're going to use October all the way down to the bottom, which it's for part B, but we'll see that as we go. So from there, then we can work out our opening stocks. So our opening stocks in August have to be the same as our closing stocks in July. So you just work back a month. So 8,050 there means it's 8,050 here. If we finish August with 8,400, we start September with 8,400. Remember, these are all minuses. If we finish September with 8,750, means we have to start October with 8,750, and if we finish October with 9,1, then it's 9,100 there. So just total those across, and that gives you your units to be produced. Okay, so that's part A done. Part B is prepare raw materials purchase budget in units in euros for the 4 months. So that's how much of materials we're going to buy. So again, it's for 4 months. So we'll write out our months: July, August, September, October, and I'm going to need November for a little bit of this as well. So I'll put in my November. Right, so we're going to take those as our starting point. That's how many we're going to produce. So we'll just take that 18,550, 11,850, 12,350, 12,850, and 13,350. So that's how many we're making. And then we need to know how many materials each one of these makes. So, in production budgets, you would have had two materials, material X, material Y, and you'd flip around with those. In these ones here, you have only one material. So each product requires 4 kilos of material X. So required kgs is 4. So obviously then just to find out how many we need, the required total is going to be the units that we're going to produce multiplied by 4. So 74 2 by 4, or 11 850 by 4, 12 350 by 4, 12 850 by 4, and 13 350 by 4. Okay, so now I can basically stop. Don't really need October from this point on, but we'll keep going. All right, so then it's the same process. It's less opening stock and add closing stock. And just be aware, it's a new business, so the opening stock is 0 for this first one. So then we follow the same process. What's it telling us about stocks of raw materials? So number 3 here says stocks of raw materials should cover 30% of the following month's requirements in kgs. So for July, we're going to need 30% of 47,400, which is 14,220. For August, it's 30% of 49.4. For September, it's 30% of 51.4. And for October, it's 30% of 53.4. Okay, so that gives you your closing stocks. And same process as the first part, your opening stocks are whatever you finished the previous month with. So August opening stock is July's closing stock. What we finish August with materials 14,820, we have to start September with. What we finish September with 15,420. We start October with, and we don't need to go into November from that point on. Okay, so we'll do our sums. See where we're at. Okay, I know I did that fairly quickly. And that gives us our required for purchases. So that's how many kgs we have to buy. The price per kg then, because we're asked to do this in euros and units, it tells us the price per kg is 350. Each kilo costs 350. So we'll write in our 350 there. It's the same each month. And then our purchases, our materials purchases in euros is each of them by 350. So 48,000 by 350, 50,000 by 350, 52,000 by 350. Okay, and that is part B done. Now, part C, you're into a cash budget. So now this is slightly harder than the last one we did, but our cash budget, and it asks us to do it again for July as far as October. So we'll July, August, September, and October. And this number 4 here, 5 and 6 is the information we need for our cash budget. So cash budget, what's it tell us? It says the cash collection pattern from sales is expected to be 20% of sales will be for immediate cash with a discount of 5% will be allowed. 80% will be from credit customers. These debtors will pay their bills 50% at the month after sale and the remainder in the second month after sale. So this is pretty much identical to a normal cash budget that you would have been doing. So you have cash sales, credit sales 1 month, and credit sales 2 months. So let's look at the cash sales first. 20% of it is for immediate cash, but there's a 5% discount. So in effect, it's 95% of 20%, which is 19%. Okay, so we're only collecting 19% of the sales. So if you find 20% of the sales, the 399, that's how much we're supposed to get, or we would get, but we're giving them a discount of 5%. So if we find 5% of that, you get 75,810. So in effect, it's 19%. So 95% of 20% is 19%. So it's 0.19, 19% of each of the sales figures. So they're given up here. So for the next one, it's 437. So 19% of that is 83,030. 19% of October's September's 496 is 94,240. 456. And then for October, it's 475, which is 92.50. Okay, so that's our cash. The remaining is 80% of sales revenue will be from credit customers. These will pay their bills half in the month after sale and the remainder in the second month after sale. So of the 399 from July, we said 20% of it is collected in July, and then 40% of it, so half of it, half of the remaining 80% is collected in August. Okay, and the other 40% is collected in September. For the 437, 20% of it, minus the discount, is collected in August. 40% of it is collected in October, and 40% of it is collected in October. So then for September's, 20% of the 456 is collected in September, minus the discount, and then 40% is collected in October. Okay, and that is, the rest is collected in November. We don't have to go into November. We're only asked to do it as far as October. Okay, so that's 0, and that's 0. So our total receipts are they're added up like so. Okay, so just add up everything that we've done. All right, so our payments then. What have we got? 1 month's credit is received from suppliers. So we have to pay 309,470 in July. That's what we need to buy. So our purchases of supplies for July, 309,470, is going to be collected in August. Our next payment of 168 from August is going to be collected in September. And September's 175 will be collected in October. October is collected in November. We don't have to worry about that. It's a new business, so 0 there. In the last questions, there was, I don't think they were giving any credit. So if there's credit for 1 month, you just move everything on 1 month. Then it gives us the bills. Wages of 12,000 plus 5% of sales revenue per month payable as incurred. So I'm going to go wages and I'm going to show this separately. I'm going to go sales commission. Now, you probably should put them together, but for the sake of this, wages is 12,000 a month as given, and then it tells us that there's a commission of 5% of sales. So it's 5% of each of these figures here. So it's not, doesn't matter when you've collected it, it's not these numbers here, it's the overall sales figure. So it's 5% of the 399 is 19,950. Then 5% of 437 for the next month is 21850. And it's 5% of for September 456, which is 22,800. And the last one, it's 5% of October's 475, which is 23,750. Okay, that's your wages and your sales commission. The next one is variable overhead, €3 per unit payable as incurred. So it's €3 for every unit we make. So you just have to be careful with this. So we're making 18,550 in July. It's not the 10,5, it's the 18,550 we make, because the variable cost is the cost per unit we make. So it's 18,550 by 3, 55,650. It's 11,850 by 3. It's 12,350 by 3. And for October, it's 12,850 by 3, which is 38,550. Okay, so they're your variable overheads, always your units to be produced multiplied by the variable cost per unit. Fixed overhead, including depreciation, 26,000 per month payable as incurred. Now you know that depreciation is a non-cash expense. So the depreciation should not be included. So what we have to do is work out what the depreciation is. So it's depreciation on equipment. So it says equipment will be purchased on the 1st of July, costing 48,000, which is a useful life of 8 years. So the depreciation per year is 48,000 divided by 12, divided by 8, which is 6,000 a year. The depreciation per month then is going to be 6,000 divided by 12, which is 500. So there's a monthly depreciation on the equipment of 500, which should not be included in fixed overheads. So fixed overheads are 26,000. We're going to change them down to being 25,500 per month. Now we'll be aware of that 6,000 per year or 500 a month later on when we come to the last part, the trading profit and loss account. So that's your fixed overhead. You've got your capital cost then. Equipment will be purchased on the 1st of July costing 48,000, so that goes in there. Now it says to finance this purchase, a loan of 42,000 will be secured at 6% per annum. The capital sum is to be repaid in monthly installments over 2.5 years, commencing in August. So he's borrowing 42,000 and he's paying that back over 2.5 years. So we have to work out how much that is per month. So in 2 years, just 12 months in a year, so 2.5 12s is 30 months. So he's paying it back over 30 months. So it's 42,000 divided by 30 will give you your loan repayment. So your loan repayment will be 1,400 a month. So he's paying back 1,400 a month each month, but not July because it tells us that he's starting making the repayment in August. Okay, so this is quite tricky actually. The interest for each month is paid on the last day of each month on the base on uh, based on the amount of the loan outstanding on that date. So the amount of interest he pays gets less each month because there's less of a loan each month. So for August, right? So I'm just going to come down actually. I'll just come across slightly on this. So for uh, for August, how much is he paying? Well, the loan is 6% per annum. So it's 6% of the 42,000. Now we're trying to find out how much he pays per month. So divide that by 12. So that'll be that'll be 210. Okay. For September, he's after paying back. He would have paid back 1,400 at the end of August. So it's going to be 6% of uh, 40,600. It's still divided by 12, okay? Because it's a monthly amount. So that is 203 for. I just wanted to see if I misread this. So he must have got the loan in July. So I'm just going to move those back. So July, August, because if he's bought the thing in on the 1st of July and he got a loan on the 1st of July. He just didn't start making repayments till August. So that's where I got that from. So for September, then it's 6% of. We're taking away another 1,400. So 39,200 divided by 12, which is 196. And for October, it's 6%. And again, he's taken away another 1,400, so 37,800. And we're going to divide that by 12 as well, which is 189. So there are my four figures. So we've got 210 the first month, 203 the second month. You can see it's going down by 7 uh, each month. So you could have worked it out. 6% of 1,400 divided by 12 would have been 7. You just take 7 away each month either. That would have been another way to do it. 196 and 189. Okay, so they're my 4 months. Just be careful. You don't nearly make them or make the mistake that I nearly made, which was to assume that the loan was taken out in August. It was clearly taken out in July, the 1st of July. Okay, so that leaves us then. I think that's all of our expenses. So it is. So we'll add up all of our expenditure, and we get 161310 for the first one, 405973, 266946, and 276389 for our total expenditure. So we're going to take those away from each other to find our net cash. So this part of it doesn't change in any cash budget, regardless of the type. So 75,810 minus the 161310. For the next one, 242,630 minus 405,973. And we've got 421040 minus 266946, which is 154,094. And that's our last one then. 447, 450 minus 276,389 is 171,061. So it's net cash plus loan plus opening cash equals closing cash. So we got the loan of 42,000. We had no opening cash. We got that loan in July. No opening cash because it's a new business. So we have a closing cash of zero, or sorry, of an opening cash of zero. We add our net cash, our loan, and our opening cash together, and we get our closing cash of 43.5 minus 43.5. So that goes up to the next one. So then we've minus 163,343 minus a further 43,500 is minus 206,843. No loan involved there. So then we've 206,843 and then add on your 154,094 gives you the minus 52,749. And we bring that up to the next month. And we'll add our net cash and our minus opening cash together. That gives you a closing cash of 118,312. So that was quite a long cash budget. And this is from a mock. I can't see how they'd ask you as long a question as this in the leaving cert. They've made it a little bit tricky. Anyway, part D is prepare the budget of trading profit and loss account. So uh, we've got our sales, opening stock, purchases, and closing stock. So our sales, and it's for the 4 months, isn't it? So it's July, August, September, and October added together. So we've got our 399 plus 437 plus 456 plus 475. So that basically, with a trading profit and loss account, discounts and all that, when you're paying for it, all irrelevant. It's about when the sales have taken place. So just add up the four there, like so. So that gives you 176,700. Now we've got our cost of sales. So normal process. It's not like the other cash budgets. We've because they're a producing business, we can have opening stocks, purchases, and closing stocks. So the opening stock, new business, so it's zero. Purchases will be our 4 purchases of materials from part B. So in effect, it's the answer from part B. So it's the 309,470, the 168 plus 175 plus 182. So that's all the materials we're buying. So that's our 834,470. Then we have to take away our closing stocks. Now, these are literally closing stocks. There's 2 of them. We've our stock of finished goods and we've our stock of raw materials. So our finished goods is from part A, 9,100. And it should have told us what the price is per good. Yeah, it tells you here. The price of one finished good is 16. So 9,100 by 16 will give us our closing stock of finished goods. And then we've our stock of raw materials. Again, so it'll be from part C here. Our closing stocks of raw materials 16,020, and we know that each one costs 350. So it's 16,020 kgs at 350. So just to remember to have your 2 closing stocks in there. That's sort of unique enough to this question. So that's the 2 of them added together. remember they're a minus, obviously, is 201,670. So then it's opening stock plus purchases minus closing stock, as always, gives you your cost of sales, which you'll take away to get your gross profit. So from there, we've got our expenses. So our expenses were, they're all listed out here, our expected costs, but we've a couple of extra ones to throw in. Okay, so the first one that we had was the discount allowed. So that's an expense. We're allowing money off to our debtors. So the discount allowed, if you remember, was 5% of 20% of sales. So it's going to be 5% of 20% of 1767, like so, which is 17,670. That was our first expense. We've none here, we've done our purchases and so on. Then we've got our wages, and our wages were 12,000 a month, so 12,000 by 4, which is 48. And our commission is 5% of sales revenue. So it's 5% of the 1767. If you look at American scheme, they might put those two numbers together uh, for 1 3. Would it be 131 or something? Um, so make sure I have these right. Should be right. Okay. So then we have our uh, so that's our wages and our commission. Our variable overhead. Now I can just take my variable overhead from my cash budget because they're payable as incurred. So it's €3 per unit. So you could add those units together, the first four multiplied by three. That'll give you the same answer, or just add up your numbers from up here. So obviously it's quicker for me to do it that way. But so you could just add those four together and multiply by three, and you'll get the same answer, 166, 800. Okay, your fixed overhead then is our next one. Now, our fixed overhead without our depreciation was 25,500. So there's 4 months of those, which is 102,000. Then I'll put in my depreciation now. And my depreciation was 500 a month, which will be 2,000. Okay, so we'll add those together, take them away. That's our net profit. Or sorry, that's our operating profit. And our last expense is our interest. So you see, we're always going to try and keep interest. Will this be new enough for the 5th years? But for 6 years, you should know this. We're try and keep our interest separate as much as possible from our expenses. So interest should always be shown after operating profit. So the interest is 210 plus 203 plus 196 plus 189. Okay, so 798, which you'll take away. That'll give you your net profit. You would hope that there'll be very few marks going for part E because it's quite long there, as you said. Um, so, part E, explain why it's important for businesses to prepare regular budgets. So, budgeting is part of the planning process, so it helps you give an indication of where you're going as a business. It allows for controls to be set in place, so you can compare what actually happened to what budgeted to what was budgeted. It allows for resources to be used efficiently. Um, it helps give responsibility to managers of cost centers to come in at certain levels. All of those things will be fine. All right, we'll see you again.